Welcome to All Things Financial with Jack Driscoll. Each week, Jack takes on all things you thought were hard to understand about your finances and makes it fun, easy, but most of all interesting. From insurance to the best way to save your money and squeeze the most out of the dollars you put aside for your rainy day. And now, you have a friend in the money business. Here's your host, Jack Driscoll.
Welcome back again, everyone, to another edition of All Things Financial. I wanted to do a series, actually, on this debt crisis that's looming on student loans and the big problem of how to finance college education. So it's a huge issue we've always dealt with in financial planning. The financial planning world, sometimes when we get involved with planning out a career family's future, we get so wrapped up in protect your assets, protect your incomes, buy life insurance, make sure you have disability insurance, the health insurance, obviously. We get to the kids and we start establishing money accounts, maybe for the kids. You know, grandparents like to do that and start up a small savings account. And then we get to retirement planning. And so often we skip over college financial planning. So we say, as financial planners, well, I don't know what to do. Because when we go through the decision-making processes, we usually find a hard time finding enough money to set aside to save for retirement. So what are you supposed to do? Are you supposed to, in addition, set aside additional monies in a separate account for college for each of the children too? It gets overwhelming. And especially when we look at retirement planning and we project this for a young family, the millions of dollars theoretically that you need by the time you retire to be safe and secure for all your retirement years, it just gets to the point where it feels like it's overwhelming. What I wanted to do today is go through a lot of these issues. I brought some resources here that I'll share with you, but I'll do a series of a couple shows here to help get you a little more comfortable. And then I'll work into a part of this series based on, okay, what about all the rest of you who are out of college already and are saddled and burdened with insurmountable amounts and seemingly unpayable amounts of student loan repayments, where there's a huge default rate right now on people that have student loans for many reasons. And the problem gets even worse because many parents of students took on student loans through either the colleges or universities that provided what they referred to as financial aid. And it turns out all the financial aid was, in many cases, was not scholarships or grants that do not need repaid, but rather student loans and parent loans that do need repaid, and many of those repaid at a very high interest rate. So now I have retirees saddled with student loans in their retirement years. Home was paid off, and they either went to the home equity and took out a second mortgage or home equity line of credit and financed their home back up to support for the financial costs of college for their kids. Or the universities or the government programs, the student and student plus loans, and took out the maximum loans yearly on behalf of each child, each kid. You know, the government programs for student loans only give up to so much on the student's name. And then we get to the plus loans and the parents' loans, where now the parents can qualify for a lot higher amounts if they want to borrow toward the college costs for their children. The problem is the parents are stuck with those loan repayments right as they're entering the retirement years. So it's a mess. First thing let's go back to this young family planning where we talk about grandparents on a newborn maybe setting aside or opening an account for the infant. And a lot of times we used to do the UGMA or UTMA accounts, custodial accounts for kids. So what we would do is we would establish or open an account in the student's or in the child's name, but with a custodian until the child reached age 18. Then once the child was age 18, they immediately became eligible for all of the funds because they reached age of majority, and they could cash them in and go finance a trip to California and blow it. So a lot of parents and grandparents had some concerns over those programs. UGMA is Uniform Gift to Minors account. UTMA is Uniform Transfer to Minors account. They're both really the same. And they have tax benefits. So let's start there. When we start with a UGMA or UTMA account, we are making a irreversible gift to that child. And the monies get deposited into that child's account with a custodian, which is usually a parent. And the custodian manages the account until the child is age 18. Social Security number and taxability on that account is to the child. So therein lies our first tax benefit. All interest earned on that account, including capital gains or any taxable earnings on that account, are tax-free to certain limits because it's in the child's name without filing a tax return for the child. So talk to your tax advisors and they can help you with that type of planning. Call us. We have the charts on that, on how much they're allowed to earn every year until they're age 14. And then after age 14, it's less. And then what happens is you get to the point where some of the earnings might, if they exceed certain limitations, become taxable to the child at the parent's rate. So it's a little bit complicated, but there are many benefits along the way. So the first reason some people open uniform gift or uniform transfer to minors account are, number one, parents and grandparents can gift up to $14,000 every year. We talked about that in prior shows, tax-free. So you can gift money, whether it's $100 Christmas money, or whether it's $14,000 a year from any one person to another person. And that means if it's a grandparent, grandfather, and grandmother, each can gift up to $14,000, which is a total gift of $28,000 combined to one grandchild. And if there are 3 grandchildren, it's a good estate transfer strategy in some family situations. Well, anyway, we get to the UGMA and UTMA accounts, and if you start those early, you may be able to get your whole family to help begin supporting your child's college education. Now, after the UGMA and UTMA accounts, the big problem that many people find is, or fear is, well, what if they turn 18 and don't go to college and use it for its intended purposes, but rather go out and buy a convertible or sports car, or like I said, get a girlfriend or boyfriend and finance a trip to California? That's not what it was intended for, and it gets everybody all upset. So then came out a number of other programs. One of the most common is the 529 plan. The 529 is also a college funding plan on behalf of a student's name, and it works similarly. Funding can come from other outside sources, just like the UGMA or the UTMA. The 529 plan, though, is a college-oriented plan for that student, and all of the earnings accumulate tax-deferred. So there are not annual limitations above which taxes must be filed, but all of the earnings grow income tax deferred, no matter how small or large those accounts are. There are requirements, though, for how much income a person can make and still qualify for being able to put into a 529 plan, parents and things like that. So you have to watch your limits. Are you eligible to establish a 529 plan for the student, or does the IRS see it just as a tax avoidance strategy? So again, call us or your tax advisors, and we will share with you the charts and the numbers and whether you qualify. We can even do an evaluation for you, a college planning evaluation on which type programs you would best qualify for. So back to the 529 plan, the earnings grows tax-free. It's tax deferred, but it grows tax-free if and when, once the child it's intended for reaches college age, if those funds are withdrawn for the purpose of and are made the expenses for college, they're actually paid in that same tax year, then that qualifies for tax-free distribution. You can deplete completely the whole 529 plan over 4 years in college, let's say, or the first 2 years, or however long it runs until it runs out. And all of the earnings and gains in all of the funds until the funds are depleted can still qualify for total tax-free income tax treatment if they're used for the college expenses. So it's a wonderful program for a lot of people because it helps leverage the amount of money that gets from you or a friend or a family or a grandparent directly into the account without paying taxes unnecessarily on any of the gains. So you don't have IRS or the state as your tax partner. And all of the monies that went in there and all of the earnings that were created all went to provide for the college funding costs. Now you might ask, okay, what if that child at age 18 or whatever age chooses not to go to college? Excellent question. If they choose to not go to college, those accounts are transferable. So if you have another child, it could be a niece or a nephew, but another child that you then want to assign that account to, those proceeds can still be held tax-free for all the gains and used tax-free for that child's education. So they stay interchangeably. We'll use the words tax-free, but it's really tax-deferred all along the way, and then tax-free if and only if, when the funds are withdrawn, they're used for college costs for the intended recipient. So it works perfectly. And the other interesting thing with 529 plans, especially with grandparents who are starting to do estate reduction strategies with their attorneys and financial planners and accountants, we're able to normally transfer $14,000 a year, as I've mentioned, from any one person to another person. But watch this. With the 529 plan, you'd say, well, we waited until the child was 10 years old or 12 years old or 14 years old. We waited too long. And if we do $14,000 a year, they'll be out of college by the time we get our intended transfer to that college student over to them. So the government has, in the 529 law, allowed 5 years worth of transfers to be accelerated and still qualify for the annual gift exclusion of $14,000. And what I mean by that is we have a grandfather who is allowed to transfer $14,000 a year gift tax free. But if they do it into a 529 plan and follow the rules properly, they can do 5 years worth in advance, up front, in lump sum. So you figure 14,000 plus 14,000 plus 14 plus 14 plus 14. 5 years worth of $14,000. And you look at that and you say, so I can get over $70,000 transferred in one tax year and not run afoul of the gift tax exemption every year. We're allowed $14,000 maximum. You can do 5 years. And if we have a grandmother, they can also do 5 years. So you look at that and you say, okay, we're in business. because now we might get up to about around $140,000 right now into a 529 plan and qualify for the gift tax exclusion and have all that money begin working right now in a tax-deferred 529 plan, and in fact maybe be tax-free. And any leftover accounts in the 529 plan, remember, can get transferred to another student if that one student's costs weren't that high. So it could be legacy planning, and in addition is an immediate estate tax transfer if the parents, grandparents in this case, feared either a state tax issue or were working on estate reduction strategies. It's an immediate estate reduction transfer of a gift. They might have other reasons. The grandparents might be trying to protect or move assets to protect them from fear of loss to a nursing home in the future, or many different things, many different reasons grandparents begin legacy planning and estate reduction strategies or estate transfer strategies. I've talked about those. Call us. You can meet with us with no obligation, and I could share with you opportunities that may exist in your own lives on what strategies you might be able to take advantage of to help not only yourselves and your children, but your grandchildren alike, and maybe people in the future by adopting many of these valuable strategies. All right, now we get to the next area, and I look at this: how else do we qualify for financing when we've waited too long? And again, I'll get into this in other shows in more detail, but when we've waited too long, we normally then find ourselves with a 16-year-old child knocking on the door of the financial institution. We're starting to look at colleges, and we're starting to talk to financial aid counselors in our high schools about what financial aid might be available. We're not going to make it. So you talk to the financial aid counselors in high school, and you talk to them about what types of schools you think you might be interested in for your students, or what type aptitudes the kids have that financial aid counselors or any student counselors might be able to help guide you to the type of career that student is best suited for. Then what you run into is you might have an A student, a straight A student in all the advanced curriculum, and you might be looking at Harvard, and you'd say, I can't afford Harvard. Well, the first caveat I will give you: there's a net cost to go to school, and there's a net cost calculator. What I mean by that is, we have state schools, and then there are private institutions for higher education. State schools, Indiana University of Pennsylvania, Lehigh, Slippery Rock. You will normally see these state schools as a very, very valid option. And we even have community colleges. We look at those as more economical options. So don't overlook those. But what we'll see with a state school, maybe tuition at a state school is $14,000 or $16,000 for a year. Maybe at CMU or Harvard, maybe it's $40,000 or $50,000 for a year. So you would look at that and say, stands to reason, Harvard, CMU might be out. They're way too much. There's no way we'd be able to afford it. But there are net cost issues with a lot of these universities, these higher education universities. And again, I'll explain what I mean. We might look at Harvard or CMU. We might even have a student apply and get accepted and find we don't have the financial resources, right? But when we go and explore further, we might find from those higher education private universities, Harvard, Yale, or even CMU, the very expensive ones, Duquesne University, they have alumni associations. They have their own private scholarship programs. We may find the net cost of going to that school, after all their grants, these things and scholarships, the ones that do not need repaid, I am not talking about commonly referred to financial aid that's really camouflaged loans that do need repaid. I am talking about true alumni programs, college, private institution, financial aid programs, grants, and scholarships that do not need repaid, that might reduce the out-of-pocket cost to the family for a student that would otherwise qualify, except for finances, below the cost of one of those state schools that you know you could have qualified for. And a lot of people don't know that. We as financial planners, that is referred to as find out not the cost of the university, find out the net cost of the university after all their programs. So you have to do some digging here, and you have to go to your high school financial or student counselors, and then you go to the institutions where you believe your student may qualify other than for finances. And you go to them and say, what do we do if we think we can't afford it? And you might be welcomed with the news, your student, your child, is the type of child we want attending here, and we're going to help you find ways to be able to afford to have this student go to our school without your having to repay. They have many programs. So most people aren't aware of that. So that's what I wanted to make sure to end today's show with is keep buckling your students down with those high grades or the sports activities or the hobby activities and talk to people, talk to these schools and the higher education universities and say, soccer, they need someone for their soccer team, but not their football teams, let's say. The little known programs, volleyball, there might, I don't know, badminton, whatever your student excels in. It's not only academia, the studies. It's many times some of these private universities are looking for certain skill sets, and they will help find the way to have you not have to pay anywhere even near what a state school would have been. And here you're going to one of these prestigious schools because of your students' unique abilities or skills. So there's so much more to this that we pass up and just assume, well, I'm sorry, Junior, we don't have the money. You're going to have to go here. You're going to have to go there. And you're missing out on many opportunities that you might have provided that you just didn't know about. They're little known. So I'll begin this series with today's show, and I'll continue this series on how to wade through this very in-depth, technical, complex process of how do we get our kids through college and still be able to afford to retire. And I will not end the series until we also get onto and delve into the subjects of what do we do if we already have student loan debt that's bogging us down and burdening us. What do we do? What can you do for us? Where we're already out the other end, our kids are already through school. Now and our students are already saddled with all this debt. We'll never be able to repay. And I'll help you work through those areas too in some future shows here. All right, folks, thanks again for tuning in to another edition of All Things Financial. I'll be back again next week.
Securities and investment advisory services offered through SagePoint Financial Inc., member FINRA SIPC, and registered investment advisor. Insurance services offered through Driscoll Insurance and Financial Services Inc., which is not affiliated with SagePoint Financial Inc.